Hi, I'm Max Keiser. Welcome to the Keiser Report. One of the great things about doing a show on RT is that New Year lasts, seems like almost 2 weeks. Stacy Herbert?
Oh, Max, it's only 8 days. You're a lightweight. We're still partying here.
That's fantastic. Well, that's because I found what's considered to be a shot in Russia, a shot of vodka. Look at this. It's not a cannonball. No, this is just a typical Russian vodka shot. A few of these and you'll be taking off 8 days or so, yeah.
Hey, Max, I learned how to say Happy New Year in Russian. Here it goes.
С Новым годом.
Oh, that's fantastic. That's really, I see you're becoming bilingual.
Well, yes, Max, this is our Eastern European special here. We're going to start with a headline here on Russia. Russia economic growth bodes well for Putin election. This is from Forbes, and they're reporting on the new statistics which say that GDP is up nearly 5% year over year ending September. The key indicator they say to watch going forward will be corporate investment. The latest figure of 7.7% year over year shows companies have started investing again after investments collapsed in late 2010. And support for the consumer sector, Max, comes from rising wages. Apparently, there's somewhere in the world that wages are actually rising. Wages have improved and unemployment has dropped to 6.3% from 6.5%, with incomes rising more in the last month than they have all year. November wages rose 7.1% higher after inflation.
Well, you can't spell brick without R. Brazil, Russia, India, China. It's an emerging growth story. It's the hottest growth country in the world.
Well, it's also, of course, has a huge, vast reserves of oil and natural gas, and I know you're going to be talking to Constantin Gurdgiev about that in the second half. He is from Moscow, and he's an economist. But the article does note that Russia's GDP is growing faster than Brazil's, one of the big four emerging markets. So as voters look around at their neighbors to the west and see one economic crisis after another, Putin's chances of becoming president of Russia again are greatly improved. So I guess there are lots of protests going on in Moscow and St. Petersburg and around Russia, but according to Forbes, they're saying because the economy is so strong compared to their neighbors all over Europe, it might boost his chances.
Protests? This is an emerging social media play. Think about it. Make a transition away from natural resources to social media. All those brilliant Russian programmers and developers creating all the new generation of, instead of the Russian billionaires investing in U.S.-based social media companies, they should invest in homegrown Russian social media companies. We know from the people out there in the social media phenomenon that they've got the talent for it.
So let's move over to the rest of Eastern Europe here, Max. The first headline, Max, franc mortgages cause pain in Europe. This is just remarkable, Max. This is regarding the carry trade that happened en masse across Europe. Now, by the time the economic crisis hit in 2007, some 2/3 of all mortgage loans in Hungary were denominated in Swiss francs. That's 2/3, Max. In Poland, more than half of mortgages were in francs, while other Eastern Europe and Baltic countries also had high rates. Now, explain to the audience here what this means.
Well, the interest rates in Switzerland are really cheap, close to zero. So people would borrow money in that low rate, and they'd buy real estate in their home countries. But they didn't factor in on the currency risk. You see, the thing is that people who are taking on mortgages in these low-rate interest environment and foreign countries don't have the same tools to sterilize their currency risk that major corporations or countries do every single day. They sterilize their currency risk. But if you're out there borrowing in a foreign country to invest at home without hedging your currency risk, then whammo, you're open to these currency moves, and this is what happened again and again and again all over the world. People are getting slaughtered by these currency rate changes and currency value changes.
Yeah, I mean, it didn't happen obviously in America, so American audience won't recognize this. But a lot of apologists for the banksters will say, well, those people shouldn't have taken on mortgages that they can't pay. But this story, more than anything else, demonstrates without a shadow of a doubt, Max, that banksters were engaged in criminal activity. Because how could 2/3 of the mortgages in Hungary be written in Swiss francs? The bankers themselves understand the forex market. They understand how dangerous it is. They understand the danger of the carry trade. But how did you expect 2/3 of the population of Hungary Hungary to understand what they were engaged in, the risks involved.
Well, people in the U.S., you say they haven't engaged in this carry trade type mortgage, but the banks in the U.S. have, and they collapsed, and now America's on the hook for austerity measures and bailouts, so they are paying.
Well, just to put into context how much these mortgage holders have been hit, the franc bought 160 Hungarian forints in the summer of 2008, but has strengthened so much that it can command 248 forints at the moment, so it's almost doubled the exchange rate.
You know, it's like offering a consumer tainted meat, basically, and that is against the law. You can't sell somebody tainted meat. And now when people say, oh, you know, this whole wave of anti-capitalism is destructive. No, it's not about anti-capitalism. It's about being anti the sellers of tainted meat. I eat meat, but I don't want to be sold tainted meat. That doesn't make me a vegetarian. I'm still a capitalist. I just don't want to eat tainted meat. Now, these banks offer the equivalent of tainted, corrupted, maggot-infested products that are sold to them, to these people, with missold to these people. That doesn't mean they're anti-capitalist. No, they're anti-criminals.
That's right. Now, Max, in an effort to stem the rise in foreclosures, the Hungarian government earlier this year, in the first quarter of 2011, they basically banned all foreclosures just for a quarter. But then they, in order to help stave off the social meltdown, the Hungarian authorities set an artificial exchange rate of 180 to allow homeowners to convert loans into forints without going bust. They interviewed Georgi Barksa, chief economist at Hungary's K&H Bank, and he says this is a better option than banning banks from foreclosing loans. This created a moral hazard. A banker should really talk about moral hazard, as people simply stop their repayments, believing that the government would bail them out. And then he goes on to say, allowing people to exchange their francs at an artificial level is less damaging to banks, but it simply delays the debt problems for a few years. Now, Max, isn't this what all European banks are doing? They're exchanging their toxic debts at an artificial level to the ECB?
Oh, absolutely. But they're doing so now, 3 or 4 years after the crisis has started. So this is why you have the currency war going on and the relative valuation of euro versus dollar. The dollar has already exchanged with the Fed trillions of dollars of toxic loans. In the ECB, that process is just starting. So on a relative basis, the euro is a lot better off than the dollar. So they still have trillions of euros to go to even achieve parity with the U.S. corruption on the Fed's balance sheet. The ECB looks like Mother Teresa, looks like the Virgin Mary compared to the Fed's balance sheet. They got a long way to go.
Basically, you have to suspend your sovereignty, your economic sovereignty, and who steps in here but the EU and the IMF, two bankrupt organizations on their own. I mean, the IMF is receiving loans from Italy and Spain and Portugal and Greece right now that they're lending back. It's just so absurd, but these people are now lecturing Hungary. Hungary warned against new laws. The European Union and International Monetary Fund are pressing Hungary to postpone action on proposed central bank and fiscal policy laws now before Parliament if it hopes to win their approval for a financial safety net to protect the indebted country during the continent's financial crisis.
Right, you're saying EU, ECB, they're totally indebted. They have no money. How are they bailing out people that are in debt?
Well,
Again, it emphasizes the theme of medievalism. Remember, during the medieval period, the papacy would get together and decide and figure out how many angels could dance on the head of a pin. You see, this was a preoccupation for hundreds of years. Here in the ECB and the EU, they're figuring out how many derivatives can they slice and dice and dance on the head of another derivative while being balanced on the fulcrum of a derivative-laced, unbalanced situation, balanced on the nose of a central banker who's standing on a beach ball in the middle of a topsy-turvy sea.
With this new law that they're proposing in Hungary, the EU and IMF say the financial stability law, which would set tax and debt policies, could limit the government's flexibility to negotiate budgetary requirements in any loan package. So the Prime Minister, Viktor Orban, said that he was trying to regain economic sovereignty. But of course, once you're in the hands of the IMF, you give up economic sovereignty.
Budgetary requirements? Yeah. We take all the money, you get the austerity. That's our requirement.
Just to go over some of the policies that Viktor Orban has introduced in Hungary, which are called unorthodox, from levying large windfall taxes on banks and other industries to diverting pension funds from private management back into state coffers. And these have apparently made investors nervous.
Hello, Argentina?
So, let's look at another former Eastern European, former Soviet bloc nation, which threw off the chains of command and control communism only to embrace the command and control interest rate setting banksters. Grand Illusion: Why Europe Should Question Wisdom of Austerity by Alan Scherter. First, let's start with this chart, which shows the biggest declines in modern economic history. As we see, the biggest on the bottom there was 1929. That's from the U.S., when real GDP declined by 28.9% over 4 years. 2007, that's Latvia. It declined by 24.1% in just 2 years. And then 2001, Argentina declined by 21.9%. 1997, Max, Indonesia declined by 14.7% and Thailand by 13.5%. You were there at the time. That was, of course, due to the
Carry trade
collapsing as well.
Absolutely. It's a common theme throughout the history of these collapses. Generally, it has to do with bankers engaged in incredibly stupid banking tricks for their benefit and everyone else's detriment. Of course, I'm looking at the Latvian economy collapse, and something reminds me of Jeffrey Sachs. How did that remind me of Jeffrey Sachs? Oh, never mind.
Well, Latvia took a $10.2 billion bailout from the EU and IMF, and the author of this article is arguing that Latvia represents a key test case for the economic policies European officials are counting on to revive the region, which is, of course, effectively a pilot study on whether economic austerity, i.e. tax hikes, government spending cuts, wage reductions, and other measures to shrink a nation's debt work better than the alternative of fiscal and monetary expansion. And, of course, they used the example of Argentina, which said, forget you, IMF, and they tripled their government spending, and in fact, their economy ended up booming after that.
Yeah, absolutely. And in Brazil also, they got rid of their IMF loans and became part of the BRICS. Growth!
And then finally, you talked about social media. Here's a headline on Latvia. Latvia probes rumors behind cash withdrawals. Well, like 2 or 3 weeks ago, there were some run on the banks in Latvia. Crash Banka in Latvia.
Crash Banka?
Crash Banka.
Who hasn't much money at the Crash Bank?
There was a run on that bank and it collapsed after Snoras Bank in Lithuania was taken over by the Lithuanian state. Anyway, then there were rumors that the government is saying was via Twitter. So Latvian authorities said that a run on Swedish banks in Latvia was started by false rumors aimed at destabilizing the country, and that is police forces were investigating the matter. But of course, this nation has embraced the neoliberal bankster financialization model, and these are the same guys that do spread false rumors in order to, benefit from the credit default swaps they've bought on any of these banks or nations falling apart.
Yeah, so Krasha and Snora, rumored to be bankrupt. What about Grumpy and Sneezy? Well, yeah, rumors, of course, are as good as anything else. The entire global economy runs on rumors because rumors traded on the Chicago Mercantile Exchange, the CME. The CFTC doesn't regulate rumors, and bankers create rumors and cash in on the rumors, and everyone else plays austerity measures. It's all about the rumors. All right, Stacy Herbert, thanks very much for being on the Keiser Report.
Thank you, Max.
Happy New Year.
С Новым годом!
We'll be right back, so don't go away.
Welcome to the future.
Science, technology, innovation. All the latest developments from around Russia.
We've got the future covered.
Hi, I'm Max Keiser. Welcome back to the Keiser Report. Time now to go to Dublin and speak with economist and professor Constantin Gurdgiev. Constantin is from Moscow and now teaches at Trinity College, Dublin. Welcome back to Keiser Report, Constantin.
Thank you, Max.
All right, Constantin, if it were to happen, what impact would a Eurozone breakup have on Russia?
There are really two ways in which the euro can break up, and we can call it orderly or disorderly. In the orderly case of a default or breakup of the euro, what will happen is that the monetary mass, or the money that are in circulation currently in euros, will be gradually over a number of years displaced out of the existence, whether in one country such as Greece or in a number of countries such as all the peripheral countries. There are different permutations in that case. In this case, the disruption will be the most minor, and the impact on Russian trade and Russian, for example, savings and investments will be very minor. The worst case scenario really comes when it is disorderly default or disorderly restructuring of the currency markets. And as a result of that, what happens is overnight, euro ceases to exist in a number of countries, and as a result of that, the other countries' euros will become repriced as well. So in that case, there will be significant disruption to the savings. A lot of Russian savings are currently held in euros. All of this will be in effect lost over time, either to devaluation or directly, or through both processes themselves, as the countries will be reneging. Eurozone countries which are exiting Eurozone itself will be reneging on some of their obligations, especially to foreign investors and foreign savers. There will be also disruptions in investment markets, which will impact Russian companies, especially corporates which are listed outside of Ireland, where they are trading either in shares or in bonds or in both. And also there will be disruptions to the investment market, so the new investment will be disrupted and flows of investment into Russia. In either case, there will be repricing of European assets. And in that case, Russian companies and Russian sovereign wealth fund, for example, will be able to enter the markets and invest in European assets at much better valuations than before. And so there is really a mixed bag, but the disruption will be very significant.
All right, now, while all eyes have been on the European debt crisis, how have the Russian banks been holding up? Are they exposed to the same mix of toxic debts that are taking down banks elsewhere?
Well, I think from the Russian banks' perspective, we have to recognize about two tiers or even three tiers of Russian banks. First, at the very top, the high-quality banks, the likes of VTB, for example, they probably are less exposed to the crisis in Europe, and they are less exposed to the crisis domestically as well. They also have very strong capital ratios, and most of their capital comes courtesy of the government. As a result of it, it's high-quality capital, what we would call. So we would expect far less disruption there, and there is also implicit sovereign guarantee in the case of those banks. There is a middle-range tier, which in itself is relatively healthy. Some of these are industrial banks, linked to the industrial assets, and as a result of that, they also are much more conservative in terms of their business lending and in terms of their development loans and things like that. So they probably will be as well okay. Where the real problem will occur is at the lower tier of the banks, the smaller banks, which have relied on the external funding, which also relied on foreign funding in many cases as well, and as a result of that, they are certainly exposed to the crisis in Europe, at least through the funding side of the markets. They're not so much exposed on the asset side, because very few Russian banks have significant exposure to financial assets outside of Russia, but they have their own problems inside Russia, and that really applies to smaller banks' tiers. Now, the government has been, and the Central Bank of Russia have been pretty active in terms of trying to reform the banking sector in Russia over a number of years, even before the crisis, because they correctly foresaw that there will be problems at the smaller tier bank kind of levels, if you want. And that process is ongoing. Will it be disruptive? Will it be very problematic for Russia? I don't think so. Assuming there are no major blowouts in global economic environment and global markets in general, assuming everything continues as it is right now, I don't really see a banking crisis of deep proportions emerging in Russia.
All right, now, Constantin, Russia recently has been admitted to the World Trade Organization, the WTO. What changes should we expect to see in 2012 as a result?
Russian admission into WTO is probably envisions one of the longest processes of accession to WTO and satisfaction of WTO conditions of any country so far on the record. It actually is stretched over 12 to 16 years, depending on different types of measures and different components of those measures. So as a result of that, you wouldn't see a significant impact in terms of the WTO accession in 2012. What is likely that we will see in 2012 is the beginning of the process whereby foreign investors start repricing risk in Russia as the trading partner for the West and the trading partner for the rest of the world. And that will be a net positive. It will start in 2012, but will continue throughout the period of accession. So next, say, 10 years even, we will see an uplift in terms of the positive valuations on the risk side of Russia as, again, trading partner and investment destination. On the Russian side, I certainly hope that in 2012 we will see an increased drive towards improved competitiveness at the industrial enterprises level and also at the certain sectors, especially sectors where Russia can be very competitive in international markets, such as agri-food, for example, also the new technologies. And if that process starts in 2012, this would be a very good marker for Russia going forward in terms of achieving both orderly admission, not just orderly admission, but rather orderly accession to WTO, but also the greatest benefits. It will gain the greatest benefits from that membership as well in the long run.
All right, let's talk about oil. Well, certainly oil is key in talking about the Russian economy. Oil prices managed to stay near $100 throughout the entire crisis, and of course, big dependency on oil and gas in Russia. If the price falls back to the $60 or $70 per range, how does that impact the economy, Constantin?
Well, I think it will impact the economy. It will impact the fiscal dimension of the economy, and it will also impact the investment dimension of the economy. Less so in the short term, the demand side of the economy. However, I don't anticipate dramatic moves in terms of the oil prices, because oil price currently, like the rest of the, if you want, storable commodities, and especially if you look at gold, if you look at precious metals, and if you look at oil, and you look less so on natural gas, for example, side, what you're seeing is repricing of those commodities to reflect the anticipation of continued quantitative easing in Europe, in the United Kingdom, in the United States, and also Japan. So globally, there is an expectation of increase in monetary mass. As a result of that, there is expected inflation, future inflation. Those expectations are also being factored in, and the real assets, what we would call, kind of physical, tangible assets, are all going up in value. You would expect that to continue, not in terms of rising oil prices, but at least the firm level of oil prices in the range of, say, 85 to 105, somewhere in that neighborhood.
Yeah, of course, it's a bit of a curse, isn't it? Because the high oil prices dissuade or disincentivize the economy to move into, let's say, more technology-based initiatives. And whereas it drops down to a lower price, there is an urgency suddenly to diversify. But putting that aside for a second, is there now some diversification in terms of a move toward, let's call it technology or social media? Certainly we saw social media on display recently in Moscow, so there's a lot of talent there. Is that in the cards going forward?
It certainly is in the cards, both from the government perspective, government policy perspective, and the incentives that are being put in place, and also in terms of the dynamic in the economy. The younger generation of the Russians nowadays are much more focused on a higher technology, higher value added, what we would call sectors, especially service sectors. They also become an increasingly traded sectors. Russian experts, for example, of ICT services, which is software-related services and social networks, as you mentioned, and other things like that, all web-based related services, has been growing at about 40% a year, and that is going to continue. The big problem for Russia there is that to continue that momentum, you have to stem off or reduce the outflow of brains, what we would call, in other words, the human capital, people, talent, which is behind that. And Russia has tremendous capacity of that talent, but unfortunately in the last few years it has been losing it very aggressively to the countries outside of Russia, and in particular to the multinational corporations. So it is crucial that the Russian government policies, and in that context, for example, the projects like Skolkovo are very interesting. Those projects act to potentially anchor multinational corporations' research and development centers in Russia proper itself, thus giving the younger Russian people who work in that sector and in those areas a bit more of an opportunities in terms of the growth and career-wise and growth experience-wise and skills-wise. And that is very, very much important because Russia currently has very competitive personal income tax rates, which is very significant incentive for people with high-quality human capital to be there and to stay in Russia. But unfortunately, it doesn't offer the same quality of promotional opportunities, corporate growth opportunities, and also business creation opportunities. So repairing those two areas, really the corporate side, the multinational corporations, and domestic business creation in these areas would be very much crucial to anchor in that talent and thereby benefiting from this growth as well.
All right, Constantin, we've got about a minute left. I want to talk about an economics kind of difference in approach. Different countries are approaching the crisis in different ways. Some are advocating austerity, some are advocating money spending by the government, printing. Now, you're in Ireland. They've chosen austerity. How's that working?
Well, Ireland has not chosen austerity. Ireland had the austerity imposed onto it by the circumstances. In most cases, the austerity has never been really chosen by the governments. Governments always pursue the objective of raising their expenditure no matter what. It really is a matter of consideration how high is the national debt. In the case of, for example, countries like Russia, some stimulus is warranted simply because Russia is not overborrowed as an economy. The government debt is very low in the country. There are significant reserves of funds, and those can be deployed in a careful way, not to overspend, but at least to invest in the future capabilities such as infrastructure investment or skills investment. In the case of countries like Ireland, there isn't really capacity. When you reach the level of debt to GDP ratios of 100% plus, like Ireland, like Italy, like Greece, and if you also have a very high, especially if you have very high private debt, you really don't have a choice. You have to bring your economy and your fiscal situation back to the level of sustainability over the long term. And that is something that Ireland is trying to do. Unfortunately, it's best done at the times of a plenty rather than in the middle of the crisis. And of course, that is the part of the economy which is not working right now for Ireland. Domestic economy, in effect, is not growing. It's continuing to shrink as a result of the austerity itself.
All right, Constantin Gurdgiev, thanks so much for being on the Keiser Report.
Thanks.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Constantin Gurdgiev. You can follow Constantin on Twitter at GTCOST or GTCost. You can follow me on Twitter as well. That's just Max Keiser. And of course, you can follow Stacy Herbert. You can send me an email at keiserreport@rttv.ru. I'll let Stacy read it. Until next time, this is Max Keiser saying bye, y'all.